Hey guys, Freaky Finance here. Today we're going to talk about a company called NICE. N-I-C-E. It's a software play. And one of the reasons we're going to do some software is because software has fallen out of favor for the first time in a long time. I mean, it's been weak for a few years now, but this year they've really collapsed. A lot of them are down 40, 50%, like material corrections, bear markets, right? So that's where some of the opportunity is. And basically the thinking is these software names are being displaced by AI. They're basically saying we don't need to spend so much on software because we can do AI in-house. And so a lot of the value is gone from these software guys and started to slowly find their way into Google, which we're overweight still. Not really Amazon yet, even though we're overweight that. And Microsoft. Those are some obvious ones. And you have the semiconductors, which are quarterbacking it. That's kind of what's happening. And we're seeing a lot of pressure, especially as we go down the, I'd say, out of the big guys. So the S&P 500, the biggest software names. Like, don't get me wrong, Salesforce is corrected materially, so we're starting a position in that. But there's other ones where I'm still uncertain. Like, even though Adobe's corrected, I've never been a fan of Adobe's products, right? So like, if there's certain ones that I'm like, okay, this has a weaker moat, and that's just a personal opinion. And that's one of the hard things with software, especially for a consumer and not a business. So I'm not sure what businesses are thinking when they're deciding to pick what softwares. And I'm not sure what other softwares are competitive with that software. And so it makes it very hard. It's probably my second, I would say, less convicted area other than healthcare and like biotech as a generalist, because you're jumping into something that you may not know enough about at the core business level, which is dangerous. So that's also another reason why I think it's under pressure, because of that uncertainty, right? We saw the same thing with healthcare. We're seeing the same thing in software. And it's because you don't have that core conviction of that software, or as soon as it gets shaken, you sell first, ask questions later. And that's kind of what's happened. Now, the big guys actually held up relatively well, even though it doesn't look like it. But when we go to the small guys, you can see year-to-date performance, minus 25, minus 32, minus 25, minus 62, minus 31, minus 55. These are collapses. They're not bear market. These are, you've got cut in half, right? And we work our way down. Like, there's so many, and most of them are like that. Some are seen as winners and have been able to basically convince the market that they've been able to tuck in AI into their existing product offering and seeing growth. But a lot of them are technically saying that, but they're not showing it as much yet. So there's still relatively weaker growth than what they have put up in the past, which is funding that thesis, right? Duolingo down 42%. 65% in just or 50% in the last quarter, 44% in the last month. Material corrections Monday. Anyway, when I see a lot of this type of blood, I get excited, so I can start looking at some software names for the first time in a long time. NICE shows the screener very well. Like, it has a historical ability to grow. It has high margins. It's already priced at 10 times earnings. Like, for a relative forward PE on anything on the market, it's already priced like it's a bank or a telco, right? It's not as bad as Comcast yet, cable, but you can see, like, relative to other things in the market, software is starting to get priced like it's going away, which is exciting because software, like this company, for example, is likely to grow 10% next year in revenue and continue to grow 10% in EPS at the minimum, I think. But that's just me, but it tells you like how price drives narrative. All right. So anyway, let's get into NICE a bit and their product offerings. The core 1IA platform, they have actually been able to tuck in the AI offerings into their existing cloud product already, and they are seeing that stick. And so it's also a thing that I like, is like, are they aware of this issue and are they likely to take advantage of it instead of lose to it? And so I was like, AI, I was like, okay, what does the company do in layman's terms? So it sells high-tech software to big companies to help them manage customer service and protect them from financial crime. So really two pillars here we're going to talk about. That's most of the business. Now, a large part is still customer service, and that's harder for me to know as a consumer, right? So unlike a Duolingo, I can open up the app and see what it is. Spotify was easier for me. Uber was easier for me because I use the product, so I understand it better. And I can understand the competitive set, why, or at MID, I have a better conviction of the competitive set. But when I jump into a name like this, it's harder for me to know, like, how does this software for customer service compare to other softwares in the market, right? And that makes it hard as a generalist jumping into software. I was like, so how does it power customer service? And basically it's like the lobby, and software picks up, understands why you're calling and routes you to the right person, right? Listen to the conversation in real time, acts as a co-pilot for the agent, pulling up your account information, and then supervision x-ray. You can only listen to a few random calls for quality control, but NICE software analyzes 100% of all interactions. And then the second part here, I have a little bit more understanding on fighting financial crime. So that's like your KYC detecting fraud, and it's really I'd say strong for banks and financial institutions. So that's kind of where this is geared towards. So I could understand the end customer easier. If I had to sum it up a different way, one platform that puts all customer interactions and tools in one place for the service agent, and then you have quality control, workforce management. Right. So if you know certain days have more calls, you can staff accordingly, and this company will also be able to help you plan that out. So anyway, customer service is the first one we're going to talk about, and these are a lot of the customers, and you can see that they're usually in the bigger names already, and they've been growing well with them for a while now. So they've been able to continue to upsell, and this is nice recurring revenue. It's also easier that way in my mind to model, and it's still growing decently well. It's slowed down, and that's another point that a lot of investors often overlook is revenue growth rate matters. The rate of change matters. So when things are accelerating, you're going to shoot the multiple up. Like this company's trade at 50 times earnings, right? It's now down to 10, right? It's like that's material margin compression. Even though the business is better, like twice as better as it was 5 years ago and 4 times better than it was in 2019, 2018. We're getting the same price now. And that's because of the revenue growth solely. The profitability profile is far superior. Anyway, it's just very interesting. They're in a lot of the big names. That's what I want to show on this slide. On the other side, in terms of the financial crime and compliance, you can see a lot of it's KYC and client management, anti-money laundering, enterprise fraud risk, and markets compliance. So a lot of this, I would say, gears heavily towards the banks. And you can kind of see that here with who they've already have. They're top 10 out of 10 top EU, top 10 US banks. So they're already there, penetrated and growing inside them. One of the reasons why we're doing to the video today is because it's all the way back down, as I just mentioned, to 2019 levels. And you can see the overreaction when growth accelerated. Most software names, actually, this is kind of where we saw the software bubble. And it's been slowly correcting down ever since. Now the business, like I said, has gotten about, we're going to see in a second, at least 2 times better from 2020. And it's about 4 times better than this time at 2019, even though we're getting around the same price now. So that's the reason for the video. Here, just to show what slow growth looks like. So this is for 10 times earnings, according to the market. 50% AI and self-service ARR growth. You have 109% NRR. So NRR, for those who don't know, basically means that for every $100 Nice earns from existing cloud customers 1 year ago, it now earns 109 from that same group of customers. So this metric's crucial because as long as you're growing more than 100%, you're growing with the same customers. So you don't need to keep re-attracting them, this high product stickiness. So they're not only staying with Nice, but they're also integrating its services deeper into their operations, right? So they're working together more, and therefore the company's able to charge more. And this is very strong when you have nice annual reoccurring revenue that's slowly increasing with your existing customer base. It's basically a land and expand strategy. And they've proven to be able to do that over the last 10 years. And they've proven to do it this year as well, just at a lower rate in terms of growth. All right, so let's keep it going. So in terms of the geographic mix, still largely in the Americas, only 10% of the business is EMEA and APAC, 6%. So very, very much still a North American story, US story specifically. So while they have linked some European banks and stuff like that, hasn't really had the same penetration that it has in the Americas. So there's a lot of, I'd say, under penetration in the rest of the world still for room to grow. In terms of the revenue breakdown by business segment, you can see customer engagement is far superior to financial crime and compliance. So in terms of the sales mix, just materially more in terms of customer engagement. So it's very critical to know where that product stands in the competitive set. In terms of the things that I really love about this company is just the innate scale on the G&A line and the SMN line. They're basically keeping R&D in line with revenue growth, which is also what you want to see in a grower. You want to make sure they don't actually do fall behind and fall into that bear case of not being able to make it in an AI world, even though their current products already have AI in them now. They're already kind of becoming the thing that the market thinks they're being displaced by. So it's kind of interesting. And we don't know which software names will actually go away and be worse with AI and which ones will be better. So it leads to this opportunity, right? And so we got to start looking through some software names. Anyway, the profitability just continues to slowly march up over time as the sales mix continues to improve. And we'll go through that in the financials in a second, why that's happening. But the margin profile continues to improve year over year. And what they're doing with the cash, originally it was kind of just sitting on the balance sheet. They're paying down debt. They do acquisitions quite a bit, which the AI missed when I talked about we'll go to the 5-year in a second. But you can see they've started to step up their buybacks. And this number is starting to be more and more important because the market cap's now only $8 billion instead of 16, right? or 12, or whatever you want to call it. This is going to start being more and more material the cheaper this thing gets. So they can still buy back a lot of their company because the free cash flow is actually up year over year. They'll be able to continue to chip away at the EPS, or the fully diluted share count rather. And here's the guidance for the rest of the year. So there's only 3 months left in the year in terms of reporting. And you can see they're basically only guiding to 7% revenue growth and EPS growth of 10%. So you're getting a PE of 10 with an EPS growth of 10. So materially cheaper than like the Pepsis and Walmarts of the world by a material amount, more than half off, but growing far superior to them, which I like. Before we jump into the latest quarter, let's just look at the 5-year here. Well, before I jump, I should say I do own this one. It's right there. It's kind of, I highlighted the ones that I'm kind of looking at. So Salesforce, Duolingo, and Nice, just because Duolingo just sold off so much last week. So that got my attention because it has also scale and a decent balance sheet. It's just, that one's harder for AI in my mind. But I'm more familiar with the app because I use it all the time. Here, Salesforce is probably the most misunderstood one, and maybe I'll probably do a video on Salesforce soon. I've been circling it for a while. And then there's certain things like Microsoft, which are just in my mind just innate winners. The easiest upsell in the world, I think, for the next 5 years is going to be Copilot to their existing customer base all over the world at $50 a head, right, or $500 a head a year. It's going to be the easiest upsell, especially as the product just gets better every single month. So anyway, I still own a decent weight in Microsoft, probably equal weight, I'd say. Not overweight like Google or Amazon, but it's up there. All I need is a little bit cheaper and I'll get excited. But that might not happen. Anyway, I own Nice, Salesforce, Duolingo. 5-year trend, you can see the revenue going from 1.6 billion to 2.7 billion, guiding to just under 3 billion for 2025. So you can see the CAGR is about 13.5%. So pretty strong growth, but you can see it slowed down this last year over year, and that's why the multiples come in so hard. Cost of revenue is a material amount of scale. Part of that is the sales mix. So cloud revenue gets a higher margin than their legacy service line and their legacy product revenue line. So you can see that just becoming materially more important. Here you can see the R&D actually stayed in line. AI I think it's about 13% of revenue, but we just saw it was around 14%. So anyway, we're seeing a decent amount of continued R&D investment in the company throughout this whole cycle, which is also what you want to see. Sales and marketing is showing scale. We've seen that over time, and G&A is also showing scale inside the sales and marketing now. The black here is just things that the AI wasn't able to handle, so I just blocked it out. But that's why these two are now together as of 21. So that's what they did. They blended at G&A with sales and marketing S&M. So anyway, operating income just goes from 242 to 546. So material improvement over the last 5 years, right? Doubled, 22% CAGR, so far outpacing the revenue growth. So not only did their revenue continue to grow well, but they grew well in the right places. And they showed scale on their fixed cost lines. So you had all that happening. So the operating margin went from 14 to 20%. So again, a great business, at least historically. Here you can see it's also getting a benefit because its balance sheet got better during that time as well. It parked cash on the balance sheet. And so you started to see interest income also show up as well. So overall, net income going from about 200 million to 440 million year over year, and the share count about flat, but now it's starting to decrease, finally, which is nice. And so you can see the market cap gone from 20 billion to 8 billion already, which is nice. So we've already seen the valuation come in at a time when the business continues to perform, just performing at a slower growth rate. Here, the net, just to show the balance sheet, it's net cash. It has no debt as of today, time of filming, which is November 15th. But they do make acquisitions with their free cash flow as well, which is the AI. It didn't pick up here, which was funny. It picked up the CFO growing, which is fine. It picked up the CapEx being light, which is true, right? So the free cash flow is pretty strong. It picked up the share buybacks stepping up and aligning with what the presentation said, which is good, but it failed to consider the actual other reason why where the cash is going to other companies. This company acquires other companies, It just made one acquisition, which I think is another reason why we're getting a price in the short term, because it lowers operating margin for like 2 quarters. So we'll see, or at least that's my understanding already. In terms of the non-GAAP diluted EPS, going from 5.70 to 11.12. Like I said, it's guided over $12 this year, which is nice. So we're continuing to see just slow, steady improvement in non-GAAP operating income, right? Revenue growth. It's been a rule of 40 score for a while, like flirting with it. So it depends when the revenue growth comes in, but the operating margin's strong. So all they really need is about 10% revenue growth, and you're gonna hit the rule of 40 every time. And that's very rare to see a rule of 40 company trading at 10 times earnings. And so that's a reason for the video, is because the price is right. It's just, what is your conviction on the core product? And that's the biggest question for me. Like, I'm going to listen to myself and say, I need to familiarize myself with the CX market a little bit more and what's being offered out there, right? Because the AI's conclusion here is spot on. The slowing growth is not a structural flaw in the core business. It's the intended result of a successful and necessary transition from a legacy on-premise model to a high-growth AI model. The valuation applies 0 value to the 49% year-over-year growth in AI ARR, so annual recurring revenue. Company's clear market leadership in the AI native contact center, where it's recognized leader by Gartner and others. Furthermore, the valuation is punishing the company for strategic forward-looking AI acquisition simply because of its temporary non-dilutive effect. So you're getting a lot of short-term overreaction to something that is proven, that they've proven be able to do in the past, and they've made the transition to cloud seamlessly. It's probably one of the best transitions there were. The AI talks about this as well when I jump back into it. In terms of what I like on the latest quarter, again, you just see like $50 million more in revenue year over year, and only having to spend $13 million to get it, right? So the business model's fine, and it's been this way for well, at least in that 5-year trend that we showed. And you're seeing scale across the R&D, you're seeing scale across the S&M, and you're seeing scale across the G&A, which you're still seeing. And you're seeing, you did have higher cash balance because they were pooling so much cash. They just spent a lot of cash in the quarter. So we are likely to see interest income actually go down finally. Though we should start seeing growth accelerate, I think, which is probably going to move the multiple, I think. But anyway, here you can see the EPS continuing to grow year over year, and the share count finally starting to go down. And this is going to be more and more important as the share price is now cheaper and the free cash flow is still higher than it's ever been before. Okay, so here you can see just the balance sheet. This is me checking the AI's work. I was like, okay, where's the cash actually going? You can see the AI failed to consider this line when I was looking at free cash flow, which is the payments for business acquisition. So company made a big acquisition, the recent one, and the AI never considered that in the history as well, like how often this company has acquired things. And it stood out like a sore thumb in the goodwill. I was like, okay, this is like the biggest negative I could find on the balance sheet is the goodwill, right? So growing inorganically as well, right? So they've had to acquire to grow, which is not as great as growing organically, at least to my mind. But anyway, here it is, and the AI totally ignored it. It's like, okay. And I asked it to do the same lens that I do with every other company. But here, I just wanted to point out in the transcript, they're seeing great momentum across our entire business, setting a solid foundation for sustained growth. Pleased to report another strong quarter underlined by exceptional cloud bookings, AI first strategy. This quarter reinforced the strength of AI solutions, driving real transformation for our customers with exceptional cloud bookings, driving cloud backlog increase 15% year over year, and with our AI capabilities included in every new 7-figure CX deal. So this is important because they're going to be able to upsell their AI, which sort of supposedly getting replaced with, based on the market multiple. Well, their backlog's accelerating ahead of their revenue growth. That's also what you want to see. That also gives me line of sight into next year. That next year's not going to be that bad, right? When your backlog's growing faster than your current revenue growth rate. That's exciting. That means as business, they just need to execute on that they've already basically got. They just need to perform. So anyway, I was more of the cloud backlog. They were trying to figure out which part it was organic versus inorganic. Basically, they said most of it is organic. So 13% backlog growth, which is nice. And this is concluding remarks, right? So they think the latest results are proof point in our long journey. they're going to present on Monday, so I want to get this video out Sunday before it, just to see what they say. So I'm hoping to understand the product more, right? Supposedly, the acquisition that they just did, which wasn't small, it was 800 something that we saw in cash anyway. For a market cap that's now only 8 billion, it wasn't small for the company. It's small for its free cash flow generation abilities, but anyway, it's basically they're saying instead of 1 + 1 = 2, they're saying 1 + 2 is 5. It's 10. The potential that it brings. So I kind of want to see what they say about this. Why was he so cavalier to say that on the call? Like, how big is this company's potential inside the NIS portfolio, right? So that is something I'm going to be paying attention to on Monday, and I'm probably going to revisit this video after and try to put my thoughts together on it. Here, the long-term strategy, the AI words things well when it has a certain bias, I find. Anyway, the bias here, the AI does like NIS here, so that was separate. It didn't like Norwegian Cruise Line that we did last video, but it likes NIS. Basically, and one of the things that the AI picked up on is the cloud pivot is complete. So this wasn't true back in 2020. Cloud revenue is only 47% of total revenue, but now it's 73% of total revenue. So unlike other peers who failed that transition, NIS has already been able to capitalize on it and outgrow. Right? They made the switch to cloud. That's proven in the last 5 years. They were very successful. And I feel like the market's discounting this company's ability to now transition to an AI cloud model, right? And given its past success, not necessarily means that it's going to be able to do it again, but it means at least it's pretty clever at figuring out how to take advantage of new technologies as they come up and how to monetize on them, right? What else? The continued scale obviously is important in the AI mode, which is the opposite of the bear market, right? Basically, they have an AI engine called Enlighten has increased a competitive moat. At least that's what the AI thinks. But again, I need to understand that moat better to be more comfortable to make this a bigger position instead of just a percent or 0.5% or 1/4% of a portfolio, right? Before I start getting really excited about the company, I need to familiarize myself a bit better with it. Here, this is just funny. The current P, forward P is under 10, right? A stark discount from the 80% discount to the 5-year P average of 51%. And that's true. Software was in a bubble for so long. It was hard to pick winners, right? We were able to pick Twilio out. We were able to pick Cloudflare. But it was hard to pick true software winners. Like Uber's in that software and Airbnb's in that software and other companies. Uber was an easier one. Spotify was an easier one. But these ones are a little bit harder to visualize conceptually. And so I need to spend more time on them. Anyway, the two-speed business model, basically the AI thinks there's a dislocation because the market's fixated on headline level slowdown and total revenue growth, right? Only 7% this year. However, this is two-speed model obscures the high growth segment, specifically AI, which is supposedly getting replaced with, that's the narrative, right? Software is getting replaced with AI. Saw 49% year-over-year growth. So that's hard for me to buy into the fact that AI is going to replace the company when it's growing 49% because of the AI offerings that the company now offers. So that makes me pretty happy. And then you have the strategic margin dilution. So the AI thinks the market's overreacting to a short-term pain because of the recent acquisition, right? It hurts operating margin temporarily until you tuck it in and start pushing it out to your customers, whatever offering this company is enabling them in terms of AI and agentic AI. Anyway, in terms of the valuations, you can see very on-demanding. You're going from $12, right? That's the company guidance, to a consensus estimate is 13, 15. So forward looking, you're only looking at 8.5 times earnings, right? For a software company that's growing at least 10% EPS growth year over year, right? So basically the market's priced this like it's Kohl's or it's Macy's or it's Comcast or it's AT&T, right? Or it's priced like it's barely going to keep growing year over year, with a potential to be displaced permanently, right? That's what it's currently priced in. And right now the numbers are saying, hey, we're probably going to reaccelerate soon, partially because of the AI offerings, and partially because the rate of change, the comp in 2025 is going to be pretty easy to beat a 7% growth rate for a company that has a backlog growth of 13%. So it's a very interesting time to look at the company anyway, and the price is right. What else I like to see before I jump in is What do the analysts think? The analysts basically all write it down. They have outperform ratings, and that helps me because they should have, especially the software analysts at a bank. That's all they do is analyze software companies, and they should be able to figure out which ones are competitive in terms of the business, like which offerings are competitive. That's not always the case. Sometimes they anchor on valuation too much. But anyway, when I see a lot of overweights, I don't really care what the price is. I'm just like, okay, what are they saying? So they still think the companies, what they offers to the end user is superior to what's currently out there. Because usually this means they're taking share from somebody. So that's what I like to look at. I also like to make sure that they're lowering their rates. Like they'll always mark the price down. So once it goes from 250 to 150, they're going to say, okay, now the company's worth less after the price has already moved. And so that's what I like. I like analysts to walk down their price. Here's a prime example. So during the bubble, this thing shot up to $300. Now, after it goes to $300, analysts will say, now it's worth $300. And then it starts going down from 300 to 200 to 150 to 130 like it is today, right? And so you start to see this walk down. And I like this walk down because analysts only walk down after the fact. So it means I'm less likely to be super early. So it's another thing I like to look at. It's possibly counterintuitive. I just don't have a lot of faith in analyst estimates, and it's one of the reasons why I think I've outperformed the market so hard this year and will likely continue to do so. Anyway, I'd like to know your thoughts. If you have any software names as your pound on the table, especially in that market cap, I'd say between $2 to $10 billion. I just think there has to be some opportunity. There are some software names that are actually accelerating with AI, right? Or are putting up record numbers, and the multiples have come in materially, right? We've seen that crazy correction that I pointed out at the very beginning of the video. Like so many software names are down 60% in a year, right? And that's on top of being like flat or down for the last two. So it's been really bad for software names, for a lot of software names anyway, not some of the bigger ones. But anyway, there has to be opportunity there. It's just hard to figure out which companies are positioned best to take advantage of it and tuck in the AI offering into their existing software stack and push it to customers at a premium price. But yeah, I'd like to know your thoughts, and have a great rest of your weekend.